Welcome, everybody. This is Marc with Cam Investor Solutions. Thanks for joining today. Today, we have my good friend, Matt Pontiff of Pontiff and Associates. He's also here in the Denver metro area, just down the road in Littleton, Colorado. Matt is a CPA, but also has a lot of other expertise in different areas such as financial forensics, business valuation, and value analysis. So I thought he'd be a great addition to our channel here around various topics, not just in tax preparation and tax planning, but those other areas. So welcome, Matt.
Thanks, Mark. Thanks for having me.
Absolutely, absolutely. 2020, Matt, has been an interesting year, as we all know. I think before we jump into some of the current events related, I thought it'd be helpful to just maybe have you take a few minutes to share more about Pontiff and Associates, given that you've been a well-tenured, well-experienced tax expert, but your firm does a lot more than that for clients, as we know. But I think for our audience, maybe just take a few minutes and share some of those other areas of expertise that you do pretty regularly for your clients at the firm.
Sure. Thanks, Mark. So we're a small CPA firm. We focus, a majority of our work is tax-based work, which really runs the gamut between businesses, individuals, estates, trusts, some nonprofit organizations that we work with. And we focus more on the planning side than the actual preparation. And we found that that's really where there's the greatest need in the marketplace. The other large component of our practice is business valuation and litigation support. So we do perform a lot of business valuations for situations such as purchase and sales of businesses, buy-sell agreements, partner or shareholder admittances or dissolutions. And on the litigation side, we work with a lot of attorneys on either valuing businesses or providing any kind of forensic accounting service that might be needed related to a litigation matter.
That's great. It sounds like, and what's interesting about that is because I think you're right, it's less maybe on just the prep, but a lot of other areas that clients don't think about they need or that their tax professional may offer. So that's great to hear, and some of the things that you do. Because I know for a lot of clients that we've seen benefit from some of those services, it is a little bit more unique, and it does dig deep in areas that can get a little bit more complicated, if you will. So that's great to hear, and thanks for sharing that about your firm. One thing before we jump into some of the more specifics of some of those things you're doing for clients, and especially right now in the current environment and going forward, I thought it'd be good to take a step back. At the beginning of 2020, there was a lot of things that were enacted in different areas that impacted, not just, let's say, traditional financial planning, but retirement planning, estate planning, and even tax planning. There was this bill that was passed called the Secure Act, which I think a lot of people temporarily have forgotten about, not in our professional areas, but I think at the individual or business owner level. And that's because there's been so much going on. So I think maybe, I know how it impacts other areas of retirement, perhaps, maybe some of the estate areas, but maybe just for a few minutes, share what you're seeing from a tax planning perspective of what the Secure Act has done or maybe has changed, given its inaction earlier this year.
Sure. Thanks for that, Mark. So the Secure Act, which was passed at the end of 2019, was probably one of the largest changes to retirement programs and plans in a long time, quite frankly. And to go through some of the changes that impact most people. One is the required minimum distribution date for required distributions from an IRA were extended from age 70 and a half to age 72. And so that basically gives taxpayers, people another year and a half in order to keep their qualified money, their IRA money, invested before they have to start withdrawing it. That's a pretty big provision. On the flip side, another big change is on inherited IRAs. So under the old law, inherited IRAs, if one inherited an IRA from a deceased family member or somebody else, they had to take the IRA distributions either out according to the deceased's actuarial lifespan or the oldest beneficiary's actuarial lifespan. So the IRS basically required um, taxpayers to take distributions out over those two periods. The Secure Act kind of closed that loop and said, we're only going to permit inherited IRAs to be distributed over 10 years and no further than that. So whenever the government passes some sort of a tax bill, there's always pros and cons, and there's what's called tax savers and then revenue raisers. So that 10-year stretch is basically what's considered a revenue raiser. That's going to raise revenue for the government, basically push more, people are going to have to pay more tax as a result of inherited IRAs. The Secure Act also eliminated the rule that people could no longer contribute to an IRA after age 70 and a half. So people are now allowed to contribute to a IRA account after age 70 and a half. So that becomes a planning tool as well. There are also some changes regarding 401k accounts. There's a contribution credit for small employers that was instituted. IRA contributions are allowed for graduate and postdoctoral students. There's also no longer a 10% penalty on distributions as a result of birth or adoption. And that's up to $5,000. So if a certain couple has their first child and they need some financial assistance, they can make a penalty-free withdrawal from their IRA up to $5,000. It's still taxable, but it avoids the 10% penalty that would normally apply at age 59 and a half. Those are some of the large changes that came about with the Secure Act and really are going to impact, I think, people over the next 10 years as they, at least people that are getting closer to that age 70, 72 time frame.
Yeah, it's interesting. It sounds like from what you said or shared, there's been a lot of things that have happened at the individual level, for families and for growing families especially, or even the retirees maybe who are getting ready to retire or just started. What about when it comes to business owners? I know you do a lot of work with business owners in a lot of specialty areas, but is there anything that business owners can be thinking about as a result of the Secure Act that perhaps also has an impact on their tax planning strategies going forward, or even right now?
Sure. Yeah. So the Secure Act makes it a little bit easier for businesses to start and create retirement programs for employees, which includes the owners if they're employees as well, which is typical. Um, One of the changes allows part-time employees to contribute to a 401k or a retirement plan. And to step back, a 401k has two components. One, a employee deferral, where the employee is actually deferring a portion of their income into the plan. And then the second component is an employer match. And the employer match is paid by the employer and deductible by the employer. So there's an allowance that would sweep in part-time employees that meet certain requirements that allow them to do that. And with the tax credit available for starting a new plan, that also becomes a benefit for businesses, existing businesses that maybe don't have a current retirement plan set up for employees, but have considered it over the years. Um, the Secure Act provides another avenue of benefit with this tax credit to be able to look at.
Okay. That's interesting. Yeah, 'cause I think that from business owners I've talked to, they're always looking for opportunities when it comes to tax planning and savings because there's so much going on. So there's been a lot of talk about how it affects individuals. So I think it's good to also highlight what you just said for those business owners who sometimes may not be aware of what's available to them. So that's great to hear. Kind of, shifting away, not just from perhaps the Secure Act, given today's environment, since February, March, there's been a lot going on, I think, in the world, to say the least. But when it comes to tax planning, certainly hasn't changed, I think, as far as being less important. Perhaps it's even more important right now and presents opportunities, as you've highlighted, for some of these changes. What are just, with your clients, speak for a few minutes, what are some of the best just tax planning strategies and opportunities that you're seeing across your clients right now and helping them with, not so much in preparation, but other areas perhaps?
Absolutely. Yeah, now is really the time that any taxpayer should pay attention, should have the radar up as far as tax planning. Um, Before the end of the year, once January 1st rolls around, your ability to manage and minimize your tax exposure is limited. Um, Prior to December 31st, you have a lot of tools, and some of the tried and true tools that really haven't changed much over the years are for cash based businesses, for example, the ability to either accelerate expenses into this current tax year, create another deduction by prepaying some of next year's expenses, and there's rules around that, or deferring revenue that you might normally recognize this year, deferring it into next year. And an example might be a cash based, let's say, law firm. And if a law firm has, let's say, going into December, has a fairly large billing, they could manage that and delay that until the end of December, understanding that they're probably not going to receive the fees on that until next year. So that's a tried and true way to kind of push income into the future. And if a taxpayer is in the same tax bracket, um, the advantage is the time value of money. Basically, it's deferring paying $1 of tax to the government for another year. Um, but managing the tax brackets really becomes very important. Kind of some of the newer strategies that have come about as a result of the 2018 Tax Act are generally related and around the Section 199A deduction, which basically is the 20% deduction that is available to small businesses that are either sole proprietorships, partnerships, or S corporations. And um, some of the sophisticated strategies that we've looked at there are, if a business is considered what's called a specified service trade or business, um, that 20% deduction is limited once their income exceeds a certain level. So there's strategies to be able to reduce their income below that threshold such that they're able to take advantage of that 20% deduction. And some strategies include making a SEPR IRA contribution, for example, maybe buying new equipment that might be needed over the near term, maybe 1 or 2 years. And under the new law, you can expense that equipment as bonus depreciation. As an example, Mark, I had a client this past year that was in a unique situation where um, by making a SEP contribution, a full maximum SEP contribution of $55,000, they were able to save almost the same amount in taxes. Now, what that means is the $55,000 SEP, Simplified Employee Pension Contribution, is not money out the door. It's not money going to somewhere else. It's basically a savings account for them. And then the government is basically providing them a match in terms of tax savings. So those are some of the interesting strategies that we can model out in tax projection. Um, Certainly going back to some of the tried and true strategies, harvesting losses at the end of the year in a portfolio. If a taxpayer has recognized gains either through sales of securities, real estate, or even capital gain distributions in their investment accounts, um, creating losses by selling loss positions at the end of the year, and then either reinvesting in the same security after 30 days has expired or a similar holding is a good strategy. It basically locks in that loss that offsets the gains that have been recognized during the year. Um, there's a lot of opportunities out there, no question.
Oh, no, those are all great. I think you mentioned the harvesting, the different strategies around for the business owner or entity type. I feel like one of the things that's still for a lot of, as you know better than me, but since it was changed back in 2018, I believe, the Section 199A. Obviously, that's the scope of that discussion is beyond the time here today. But the one question I have around that is, do you see clients, whether they're a sole proprietor or a larger entity, do you see clients really taking advantage of that to the fullest extent? I feel like when we have discussions that a lot of folks are confused or just don't know enough about that topic.
I think that's a true statement, Mark. I think there's a lot of low hanging fruit, if you will, in terms of tax planning with a lot of clients. And a good example would be, um, let's say a client has an S corporation, and they happen to be paying out all their profits to themselves as wages. So wages do not allow a Section 199A deduction, a 20% deduction. However, the pass-through income that comes through on their Schedule K1 does. And of course, this is a general component. So if they can, let's say, reduce their wage amount and still keep it a reasonable amount under IRS guidelines, and therefore increase their K1 income, the 20% applies against the K1 income. Doesn't apply against the wage expense. So managing owner compensation is a very important tool in small businesses with S corporations. And we get very heavily involved in that at this time of the year, assessing not only year-to-date wages for a client and determining if it's reasonable under the IRS guidelines, but also managing, okay, how can we maximize that 20% deduction that actually applies against the non-wage income, which, by the way, that non-wage income gets paid out to the owner through S Corp distributions. Mm-hmm. So there's no double level of tax there. So by taking that strategy of reducing their wage, increasing their pass-through income, not only do they save on payroll taxes, but they may also increase their 20% pass-through deduction.
Yeah, and that's an area that whenever, as you know, whenever we have clients, we encourage them to get advice. While we can help them with some areas of tax awareness and tax strategies, when it comes to things like that rule or that change, there's a lot of things to consider. So, and I do feel like there is a low-hanging fruit element for taxpayers and business owners or entity owners to take advantage of, or at least get a second opinion on, because they're leaving money on the table or giving it away to the tax man per se. So I think that's a good point. Kind of shifting gears to some of the current events. I'm not a health expert. I'm not a political expert. I kind of tend to stay in my own lane of what I know and don't know. So with the upcoming election, I'm not here to debate topics of views or who's going to win or not. I'm just looking at it from the standpoint of, if clients, knowing today what they know about the potential outcomes, is there anything that clients and taxpayers might want to be aware of, regardless of any outcome in the presidential election, the Senate, that maybe they can look to take advantage of before year end in particular? Because I think that's a really important topic to highlight potentially for a lot of our audience.
Yeah, good question, Mark. And I agree with you. I'm not a political expert nor a health expert. But, you know, in my experience, in my practice with over 30 years of doing this, it's very unlikely that there's going to be any significant tax changes in the 2021 tax year, for example. So we're in the sunset of 2020. Regardless of the election, whether the current administration stays or there's a new administration, it's highly unlikely that there would be any tax changes next year. If there is, it would likely occur in 2022. So I expect, and this is a prediction, I expect that tax rates at least will maintain consistency into 2021. In terms of kind of some strategies as a result of the pandemic, the COVID pandemic has caused a lot of businesses, a lot of individuals to incur losses. And, in terms of creating lemonade out of a lemon, if a taxpayer has a loss, maybe it's a net operating loss, under the CARES Act, they can now carry that back up to 5 years to obtain refunds of prior year's taxes. They can also carry it forward as well. But another good strategy that certainly dovetails with your expertise and how you work with clients is also looking to convert traditional IRA money into a Roth. So that becomes very tax advantageous when a client's in a very low tax bracket. Conversion from a traditional IRA into a Roth is a taxable event. So if a client has a zero tax rate this year because of losses, then they may have an opportunity to convert traditional IRA into a Roth and create a better long-term strategy for themselves. And that may actually be a better choice to do that than to either carry the net operating losses back or to carry them forward. And certainly that requires, some good sessions with you and their advisors to determine if that's the right decision to make.
Right. Yeah, that there's several you highlighted, and I think that last one is something that we're seeing a lot more discussion with clients around, because one, it's doesn't perhaps take as much complicated thought, right away. I think it's in front of us. We can definitely jump into it, but the tax aspect is where it gets complicated, as you know, because going forward, you have to think about how to pay the tax. How does the math shape up in the future? So it seems like there are some things that people can take advantage of now with what they have in front of them without necessarily knowing, like you highlighted, I think, that we don't know maybe what's going to happen down the road, but perhaps now what we do know, there are some opportunities that clients can take advantage of now that could save them some tax in the future or right now. So that's good to hear. You mentioned, I think, or one thing I've heard questions on recently, and maybe you've seen this with your clients, is with the pandemic, you've seen people spending time elsewhere, maybe away from where they live because they can work remotely, or they're thinking about possibly relocating because of a job change or a lifestyle change. And I think that's exciting for a lot of people, but I do know that there are some tax considerations around that. And I've had that question, I'm sure you have. So I guess two questions is, are you seeing some of this same activity with your clients? And what do you suggest that clients keep in mind when it comes to possibly relocating or working in different areas of the country for parts of the year? Because I think that's an area that clients can get blindsided from conversations I've been privy to in the last few months.
Yeah, it's definitely a hot button issue, Mark, no question. And with more people working remotely, the question has come up. Well, particularly if they're an employee, not a business owner. If they're an employee working remotely, I've had the question, well, can I write off my home office, my internet, um, expenses at home of using my home office? And under current law, unfortunately, as an employee, no, you cannot. The 2018 Tax Act eliminated the deduction for miscellaneous itemized deductions, which included unreimbursed employee business expenses. So that puts taxpayers in that situation in a difficult position. And the best outcome that I see is to negotiate with their employer a reimbursement arrangement. And even if it requires a reduction in their income, to get reimbursed for those expenses, it's actually a win-win for both the employer and the employee, because the employee's wage or taxable income gets reduced as a result of reducing their income and receiving a reimbursement instead, because reimbursement is non-taxable income.
Right.
The employer, on the flip hand, they reduce the amount of payroll taxes that they have to pay. So an employer reimbursing an employee for valid business expenses, which a home office is a valid business expense, is definitely a win-win. And I've seen that with larger corporations kind of become a hot button issue, but it's definitely something that small employers should look at as an opportunity. And I expect that there may be some legislation addressing that in the next 6 months. But as you know, that's hard to predict.
Yeah, no, and your point I think is right on, because yes, the big companies have to think about this when they have perhaps thousands of employees, but even for you and I, when we have folks working from home potentially still, or part-time, or at different, schedules, it is a consideration for just some of those basic things like internet, like cell phone, like home office, or just depending on how long this lasts. So I think that's a really good point, and we probably haven't heard the last of it. So thanks for sharing your thoughts there, because I think that's something that I have received that question a pretty good amount. I guess one kind of final topic I wanted to touch on, because I think it does impact a lot of people, and that's this around real estate. I was thinking about it this morning actually, because someone had asked me a question around real estate and the impact it might have, not so much even on our own ownership, but around like rental properties and different things. How do you see real estate changing, not because of, it's going to do well or not, but more or less the tax strategies around owning real estate, whether it be your own home or a rental property, perhaps? Because I think that that's a question a lot of people are asking, given there's been so many things in kind of a state of flux right now when it comes to people living elsewhere, renting their homes, or selling their homes even. Maybe share your thoughts on that, if anything that relates to your clients.
Sure. So real estate can be a good tax play. However, real estate by definition is considered a passive activity unless the taxpayer is actively involved. So most people that have a day job and maybe have a rental property or two on the side generally don't qualify as materially participating, let's say. Um, so, from a tax standpoint, I see a lot of clients that will have a rental property. It generates tax losses, but they're not able to claim them because they don't have passive income to free up those losses. Those losses then sit on the shelf until they either sell that property or they generate passive income. Under current law, taxpayers can deduct interest expense on up to 2 personal homes. They can deduct real estate taxes on any personal real estate that they own. However, the total tax deduction under the new law is capped at $10,000, and that includes both real estate taxes, state income taxes paid, auto registration taxes, and so forth. To go back and touch on your earlier question regarding clients thinking about moving to a different location, maybe, a common situation is a vacation home and using a vacation home in the mountains as a primary residence. We've seen a lot of that. And, certainly one thing to be aware of is under current law, your home, if you sell your home and you've lived in it and owned it for at least 2 of the last 5 years, if you're married filing joint or you're married, you have a $500,000 gain exclusion. If you don't meet those conditions, the gain is taxable. So that's an important distinction. And we've seen a lot of clients that maybe have a long-term residence here in Denver. They sell it, they've lived in it and owned it for over 2 years. They exclude all the gain. They move now into a vacation home that they've had for a while, that they've rented out in the mountains. And now, as long as they live in that new vacation condo, home, whatever it may be, for at least 2 years, they can then exclude another $500,000 of gain. And there's some rules as far as previous depreciation on that, but that's something to be aware of if they're moving their residence and they do have either income properties or vacation properties to consider.
That's a really good point, I think, to wrap up on, because I think a lot of folks who own real estate, whether it's their primary residence, been a second home, or rental, that maybe they're reassuming in the mountains to live in or make it their residence for various reasons, aren't aware of that. And we see some of that in the data, I know, as financial planners, how frequently Americans have moved in the last 10 years than maybe the prior 20 or 30 years, that activity of moving. So those tax rules you highlighted of making sure that it has been a primary residence for that certain time frame to reap the tax benefits is key, because I think sometimes people forget that, depending on where they've lived, where they've shared residences, split time, that may not qualify for those tax benefits and tax breaks. So really great points. Matt Pontiff, Pontiff and Associates, thanks so much for joining. I'm sure that we'll see and get more outcome in the next couple of weeks and months ahead. And so we'll have to have you back and recap all the stuff that potentially has changed or maybe hasn't changed of what we should do going forward. So thanks again for the time, and I'll talk to you soon. Appreciate it. Thanks, everybody.